Good afternoon. It's Jeffrey Christian of CPM Group. It's about 3:35 on Monday afternoon, the 19th of May. I'm recording this Monday afternoon because Elliot and I will both be out of the office on Tuesday morning when we normally process the Tuesday videos. So I wanted to talk about risks and opportunities for gold and silver, where we are at in the middle of May 2025 in terms of the factors that have been driving investment demand for gold and for silver, and the turning points that we're at. I don't have a lot of slides here, but I did want to pull this one up, which is the US dollar. We continue to hear how everybody's running away from the US dollar, and the dollar is plunging and collapsing, and no one wants the dollar anymore. And while the gold promoters have been saying that, the dollar has in fact weakened. It's off 5% from where it was at the beginning of the year. And you can see here, it's down all the way to where it was in October of 2024. It's also up 9% from its 2021 low, which was reached in June of 2021. And it's up 44% from where it was in 2011 at the end of the Great Recession, global financial crisis, European and U.S. sovereign debt problems. And that last point's kind of important to talk about because that was, in August of 2011, the first downgrading of U.S. Treasury credit ratings by two of the three credit rating associations. That occurred in August of 2011. The gold price rose sharply for a few weeks, peaked in the middle of September 2011, and then began declining. So that was sort of the low that we saw, and it was in the aftermath of this downgrading of the U.S. Treasury that had occurred, that had been anticipated for decades by gold promoters and gold bugs. I'm going to be at a conference tomorrow speaking, and on Wednesday, they have a video of two people who have been promoting the idea that the U.S. Treasury market would collapse and the budget deficits were unsustainable and the U.S. debt would collapse, the U.S. economy and gold prices would go to phenomenal levels. And each of these people have been talking about this for decades. One of them since the late 1960s. One of them, both, and it's just, they've been wrong. It's funny, kind of that weird, strange way where people who believe things have their beliefs disproven, but decades later they still believe them. My theme here is that there are so many things that could go either way at this point. I'm going to talk about the Treasury's credit rating reduction last Friday, tariffs, U.S. legal and political battles, the Middle East, Russia's invasion of Ukraine. If I think about it, I'll talk a little bit about gold and silver's physical markets. And there are all these different things, and the powers that be are trying to paint pictures, rosy pictures here. But they're using watercolors that could be washed away by spring storms. And there are a lot of spring storms on the radar. Reversals of what could happen are highly probable. And that's not to say that good things won't happen. It's just to say that there are risks that are still there that perhaps are being ignored for a while. And there are opportunities for investors with both those risks and if those risks come to fruition. And I should say that we're looking at, gold prices having come off a little bit over the last few weeks. They're coming back up. Gold is at $3,236 as I speak. Silver is down to $32.52 if you want to say it's down. These markets are showing some signs of doing what we had expected, which was to be very strong in the first 4 months of the year and then sort of move sideways to downward in a volatile fashion, not falling a lot, but somewhat between, say, May and August or September, and then starting to rise again because, and one of the factors that we have behind that projection, which we've had for many months now, has been that you would have a lot of political and economic problems that would be focal points for financial markets, pushing investors and stimulating investment demand for gold and silver in the first 4 months of the year. That in the middle part of the year, those problems wouldn't necessarily be solved or disappear or go away, but financial markets would become immunized, if you will, RFK, apologies. The markets may become a little bit immunized from that, and you could see prices move sideways. No one's going to give up the ghost. No one's going to expect all of these problems to be resolved. Some people might, but the portrait, the image, the illusion that these things are being resolved could cause financial markets to calm down a bit. And our view is that those risks remain. The markets will perhaps overprice them somewhat. Markets may underprice them for a few months, but by the end of the year, we think the markets will be overpricing those risks again, or rather pricing them better. Let's start with the Moody's Treasury credit rating move. Moody's is the third credit rating institution to downgrade U.S. Treasuries securities. The other two did so in August of 2011. So Moody's is kind of late to the game. It's been done. What happened in 2011 was that it came at the end of several years of global financial crises and concerns about sovereign debt risk and concerns about the growth of the U.S. deficits and debt. By 2011, you were looking at pretty nasty economic environment that had seen the greatest recession since World War II from 2007 into 2009, and then international debt problems in Europe with the Eurozone and the southern tier of the Eurozone, and in the United States. That was then. This was not 2011. Some of those problems are much worse. U.S. deficits, U.S. debt. I think by 2011, U.S. deficits were probably down to only $400 or $500 billion a year. They're likely to be more than $2 trillion in the next several fiscal years. So some of these problems have gotten worse, but the world has managed to live with them. And just as there were people, some of those same ones that are talking about $10,000 gold today, we're talking about $10,000 gold in 2011. Just as those guys were still there are any number of investors who say, it didn't collapse then, and maybe it's not going to collapse now, and maybe the people who are calling for a collapse are missing some very important cogs in the gears that run the global economy. So Moody's downgrading of U.S. Treasuries could lend some support to gold. It probably has today. The gold price is up about $50 from where it was on Friday afternoon. So it could lend some support on the near term, but we don't think it's going to be a major factor because there are other factors that are much more important. Similarly with tariffs, we've seen round one and it's sort of winding down. It's not over completely yet, but round two will come soon. Mr. Trump threatened about tariffs for months. from before the election until April 2nd. People around the world said that's not a good idea economically or politically. On August 2nd, he came out swinging against pretty much the entire world economically, full of fact errors and lies and deceptions. The financial markets, including the U.S. Treasury market, reacted very poorly. He backed off from a lot of that stuff, but he hasn't given up the ghost. So with China, he's gone from 245% tariffs down to 30% tariffs, which are still too high. But that's a temporary thing for 90 days, So that argument will come back. Arguments with other countries also should be expected to not disappear right away. So tariffs and trade wars will continue to impinge upon global economic activity, raise the prospects of a recession, a deeper recession sooner and longer than otherwise would be the case, and put downward pressure on corporate debt and on equities. It's not over. So too, the political battles that we've seen in the United States since Inauguration Day. I think there's something like, I don't know, I think one person said 40, another person said 140 injunctions against things that the Trump administration is trying to do. They passed a massive trade tax cut for wealthy and the corporation late on Sunday night. I was talking in a previous video about the creation of the Fed, and I pointed out that there were any number of Congress people who repeatedly blocked the creation of a national central banking system because they were taking large payouts from state chartered banks that didn't want federal regulators having the power to audit them and make sure that they were doing compliance. And so you had, from really the creation of the United States into 1913, 1914, you had repeated bank runs. You had bank scandals where the banks didn't have the assets behind the money that they were printing. Currencies were printed by individual banks. States didn't have the wherewithal to audit them to see that they had the assets. You would have bank runs, you'd have depressions, you'd have periods of high inflation as a result of all of this. And the people who wanted to create a national central bank, the Federal Reserve System, were stymied in Congress by Congress people who were taking vast amounts of money from bankers. So late on the last day before the Christmas recess, certain people stayed behind. Other people left for the recess, and they passed this. And I pointed out that it was done late at night. There are conspiracy theorists who say, oh, it was done late at night because it was a conspiracy of evil doers. But what it was it was done late at night when they could get enough votes to pass this thing because the guys taking the payoffs from the banks had already left town. And some troll made a comment like, if everybody's left town, how did they pass it? Who voted for it? Well, not everybody did it. And it was astounding that somebody would even think to write that because it happens all the time in Congress. And it happened yesterday. It happened last night. On Friday, one of the things that happened was that 5 Republican Congress people actually found spines and voted against this outrageously inflationary and debt-ridden budget. So they waited until those guys had left town and they voted Sunday night, late at night, and they passed it. That's how corrupt governments work. And that anybody would even question it is beyond my comprehension. But that's what it is. So we have a lot of legal and political issues. We have a lot of governmental issues. The deficits are rising sharply. In the first 80 days of the Trump administration, the government spent $154 billion more than it had in the same period of 2024. We've got a lot of economic and political problems that are going to continue to be problematic. They could be better. We're seeing some decent economic data right now, but a lot of that is actually people buying stuff and importing stuff and doing things before the tariffs kick in on a variety of activities. We have the Middle East. The Gaza war is continuing. People are talking about how it's going to wind down, but there's no effort on the part of the two major militant groups there to actually wind it down. And it is a terrible situation that's going to continue. The U.S. is threatening to nuke Iran. Iran is in a weak position. You have the U.S. actually trying to rebuild some semblance of respect for Arab nations. Mr. Trump went there looking for business for his family, but while he was there, he made a very important and astute comment. He said, the United States government's going to stop lecturing Arab governments and start talking with them. Probably not going to happen, but it could. And then you have the Russian invasion of Ukraine. And there's all this talk. Today, Mr. Trump spoke with Mr. Putin, after which Mr. Trump said, hey, this is going to be negotiations between Ukraine and Putin, i.e., I'm not solving this in 24 hours and no one actually wants to listen to my ideas, so these two guys can go their own way. And he sent out little J.D. Vance to talk about how the United States was not really committed to these negotiations and could walk away from the negotiations completely after Mr. Putin said, hey, you're not one of the warring parties here. You're just supporting one. Mr. Putin has very clear objectives. He and Zelensky and the EU and the U.S. administration are all talking about how they'll get together and they'll have negotiations. But Mr. Zelensky has been very clear, as has the EU, about what the Ukraine wants in terms of a settlement, and they do not want appeasement, and they do not want to give up a significant portion of their territory to this recidivist view that the Ukraine really should be part of Russia. Mr. Putin, for his part, has made it very clear. He wants a significant portion of Ukraine territory to become part of Russia and to be recognized by Ukraine and the world as being part of Russia. And he wants the rest of Ukraine defanged. Will never be part of NATO, will never have a defense system. Its military will be basically neutered to the point where it's like a national police department. None of which will be acceptable to Ukraine, none of which will be acceptable to the EU, none of which should be acceptable to the United States if we had a legitimate government that isn't in Mr. Putin's pocket. Bob Gates, former CIA director, former Defense Department person, was on Face the Nation on CBS Sunday morning, and Margaret asked him about Mr. Trump's view that if he sat down in person with Mr. Putin, he could solve this thing and negotiate it because he would get into Putin's understanding. And Gates worked very hard not to grin and said, look, first off, it's pretty clear what Putin wants. He's made it very clear, and he's made it clear for years. The second thing is that it's very hard for Westerners who don't understand Russian politics and Russian culture to fully understand it, and that of the people who might understand it, Mr. Trump is probably not particularly one of them. It's sort of like, well, we won't go there. So there's talk about negotiations and a ceasefire. But the two sides are 180 degrees apart from each other as to what they want before the fighting stops. So there are all these issues that are being painted as being resolvable and likely to be resolved, and the tensions will be reduced, but they're highly unlikely to actually happen. And the risks of things getting worse again and pessimism of good developments rising, and that all driving investors to buy more gold and silver, is very high. We have a probability of over 50% for that happening over the next 6 to 8 months. So that's sort of where we're seeing. There are risks to being long gold and silver, and there are opportunities that the prices may soften a bit over the next 6 months, giving investors the opportunity to buy more. And then also central banks will buy more if you see a significant decline in the gold price. And then the opportunity that we'll see higher prices later as things continue to worsen. So that's the economic environment that's fueling things. Now, as I said, gold prices, it's very funny because people were talking about how gold prices have fallen sharply, from 3,500 for a brief period of time in the middle of April down to, below 3,200 last week, trading around 32.36, got up to about 32.50 this morning in New York. Our expectation is the price will maybe move a little bit higher in the next couple of weeks for a variety of economic and political factors, as well as factors within the gold market. We are moving toward the active June gold COMEX delivery. There's about 18 million ounces of open interest in the June contract, most of which will be rolled forward into August over the next 2 weeks. That roll and closing out those positions for those that don't want to roll them forward will have some effect on supporting the gold price, if not moving it higher. Beyond that, we do think that seasonality and that immunization from the political and economic crises that we're seeing will kick in, and that the gold price will come off, but probably stay above 2,900, if not 3,000, for the next several months, while trading sideways in a very volatile fashion. And I want to point out, the price at $30,200 is higher than it's ever been in history prior to the middle of April, the middle of last month, a month ago. People are gold bugs, and those who expect too much of gold are complaining about the sharp decline in gold prices. But the reality is that the gold price is at record highs and will probably remain at record highs for the foreseeable future, the next several quarters, even if they come off some. Silver, with gold, you're seeing, investors buying more gold, more ETFs being bought, which is a reflection of non-traditional gold investors coming into the market. With silver, you're continuing to see liquidation. And part of that reflects the fact that the silver price, $32.52 when we started this video 23 minutes ago, above $32, silver prices are pretty hot. And they have any number of people who bought silver 2021, early 2022 during the Wall Street silver scam and the squeeze silver scam. Those were both scams. Some people have realized they've been scammed, others haven't. And the scams continue. But there are any number of people who bought silver that when you added the coin premium or the small bar premium, all of a sudden they were paying $32, $33, $35, $36, even higher than that. And some of those people have been, for the last 2 years, liquidating some of that as the price got back up to $28, then $30, and now $32. And that continues to be a headwind to silver prices. At some point, that stale bull liquidation selling will end, at which point you'll see that there is other silver demand, that other silver investors in the United States, Canada, and South Asia have been buying and will continue to buy, at which point we do think that the silver price will rise more sharply. But we're seeing weaker investment demand in the first few months of this year than maybe some people had expected. We think that if the price comes off and it goes back down to $30 or even $29, you'll see bargain hunting investors come back in. And then if we're right on the economic and political environment and it worsens in the final 4 months of this year and the price of silver starts rising, you probably will see other investors coming into the silver market once more, possibly using ETFs because they are more efficient than buying small bars and coins. But some of the people will buy small bars and coins. You have a large amount of silver in 1,000-ounce bars stacked up around the world. You have a lot of the smaller investment products being melted down and cast into 1,000-ounce bars, good delivery bars in New York and London and elsewhere. And that's hanging over the market right now. That's all I have for now. We'll be back on Friday. I'll be back in the office. We will be launching our Silver Yearbook for 2025 next Tuesday, the 27th. We're working frantically to get the report done by then. It'll be very interesting. It will talk about the surpluses that are existing in the silver market, and how there aren't deficits. We'll be talking about investment demand trends, mining production, secondary recovery, fabrication demand, in a variety of industries, including, the growth industry, which has been solar panels, although that industry has hit some major headwinds over the last 2 years, continuing into 2025. Growth of the solar industry continues, but it's not as dynamic as it was earlier. That's all I have for now. Take care of yourself. Take care of those around you. Try to do something good for the world, and we'll talk to you on Friday.